Okay, good exam technique is obviously just to scan the question, just to get an idea of what they're giving you. So you've got John and Levy, they're in a partnership, sharing profits and losses equally. They had an agreement. Then you've got a financial position, statement of financial position, non-current and current assets, capital, John, and you've got the current accounts. Okay, additional information. You've got a few points there about the partnership. What does point number 1 ask you to do?
The revaluation.
Okay, can I use the textbook just to make sure that we use the right format? You can use a T account for this, but let's see what they want in terms of the structure. Okay, so just to revise, when do you do a revaluation?
When you sell.
When the partnership changes.
Yeah.
Okay, so the partnership is changing. Okay, that's appropriation, that's the lines. Let's see, revaluation, okay, normal T account, that's fine. Okay, so T account, let's draw one up. It's going to be quite a big T account because you're looking at all the assets and liabilities of the business and you're looking at how things have changed. Okay, so debit side, credit side. Normal T account. Okay, the heading for the T account, revaluation. How much marks is this out of? That's always a good guide. Okay, this looks short. It's only 3 marks, so it won't be a very big revaluation. Revaluation account. Okay, so we know a revaluation account is drawn up when you have a change in ownership. Obviously something is changing here. We need to know what. Okay, so we've got the T account. Let's look at the information. Okay, so you know that there are 2 partners. That's important. The additional information will tell you about what's happening. So what does the additional information say? 1 October, D joins.
D joins the partnership. The partnership agreement was drawn up. The terms set out in the agreement were: profit and losses are to be shared equally.
Okay, so that means you've got 3 partners, so a third, a third, a third. Okay, for the new partnership. The old, it's John and Levy.
Interest to be changed at 5% on drawing.
Okay, so we know there's interest. Yeah,
and
interest on
interest to
drawings.
be allowed at 10% on capital.
And interest on capital. What else?
The following also took place. David introduced capital of 80,000, which he had paid into the business bank account.
Okay, that's important because that's the new partner's contribution. Okay, then they say Goodwill was valued at 60, but no Goodwill account is to be maintained in the books of the account. So Goodwill is what the existing partners had created. There, point number 3. That's what we need. Okay, you can highlight point number 3. Point number 3 is required for question number 1. Okay, this is well, A actually. Okay, question 3A, that's the point we need, point 3. Okay, so what does point 3 say? Just read it out while you're highlighting it.
No current assets were revalued. Non-current assets were revalued at 27.
Okay, so if it's the non-current assets, how do you increase a non-current asset?
By debiting.
Exactly. So you would have debited the non-current assets and you would have credited the revaluation. Okay, so what day was this on? Okay, they don't specify. We need a date. We'll probably use the end of the year. What is the end of the year? Where's the date? Do you see anything? Oh, there. 30th September. This is non-current assets. Okay, because remember, you would have debited the non-current assets, so you would have to credit something else. This is the credit. How much was the credit for? Let's go back and see. 270,000. 270123. 270. Okay, do we need point number 4? Yes, point number 4 also talks about evaluation. Okay, so blue as well, you can highlight that. Inventory needs to be valued at what? Higher or lower?
Reduced.
Good. Okay, so how do you reduce the value of inventory? Inventory is a asset. How do you decrease the value of an asset? Good. So if you're crediting that, you would have to debit this. Does it make sense? Okay, that's how you approach it. 30th of the 9. Inventory. All of this will be general journal. Okay, so if you're wondering what the reference is, folio, you can put general journal for all. Okay, how much did the inventory decrease by? Reduced by 4,000. Okay, so 4,000 goes there. Right, what do we do with the revaluation account? You need to balance it off. Does the revaluation account have a closing balance? No. Okay, so what must you do? You need to close off this account, and you need to close it off to the existing partners. Okay, so 270,000 is the bigger total. Okay, so that goes there, that goes there. Okay, the balancing figure is going to be then for capital, right? Because the partners get the benefit. So 30th of the 9, capital. What were their names again? John. Capital levy. Okay, so John and Levy each get a share of the benefits. We need to work it out. Okay, so they say in the question that they shared profits and losses equally. So what is the difference here? I'm just doing a separate calculation. This you don't have to show. The difference is 27 minus 4 gives you 266. Okay, half of 266 goes to that partner. Other partner gets the other half. Okay, so John gets that, Levy gets that, and they both increase the capital. Okay, that makes sense, because think about this. What does the revaluation do to the assets? It increases the value of the assets. So that means they've got more equity in the business. So if you're debiting this, you're crediting that. Okay, the end. Next bits. What does B ask for?
Okay, B asks for, let me just write this out. Prepare the capital accounts of the partners to record the admission of them. Okay,
so now you're adding a new partner. They want you to prepare the capital accounts. Okay, so let's see, in terms of, okay, they've done it as a T account here. So we can also use a T account. Or maybe, okay, so there's two ways of doing it. You can decide, do you want to do it this way, lines, or do you want to do it this way, T accounts?
I think they like the columns more, hey?
They don't specify, so it's kind of like...
Let's do it like this.
Okay, so then you do like that. Okay. Right, so options here. Option, T account, or disclosure line item, or line by line. Disclosure bracket line by line. Okay, both are acceptable. They don't specify which you should be using here, which is a problem, because they should be a little bit more, let's say, precise, so that you know what to do. Okay, because I know in the past, last year, when we did things as a T account, they didn't mark it right, because they wanted the line item. But it was exactly the same thing. Okay, so you don't have to show both, but I will show both. Okay, so at least you have something that you can refer to in case they do ask you for this other option in the future, and then it's not like the first time you've seen it. Okay, so let's see. I'm just going to make it smaller, not as big. Shrink it a bit. Okay, there we go. Alright, so I'll do the normal, this was for capital, hey? Yeah, capital. So we need capital for, okay, so if you're doing it in columns, you're going to need one column for the one partner, one column for the other partner. Okay, so two columns. Let's draw them up. So capital, John, capital, Levy. Okay, so that's the other option, is to do it in column format. Disclosure line by line. Delete that and copy paste. Alright, so capital for John and copy paste Levy. Okay, so that's what we've got. Right, what must the account always start with? A balance, obviously. Okay, so opening balances. Let's look for them. Question 3. There, capital account, John and Levy. John had 200. Levy had 70. Okay, so you would have shown that there. If you were doing it as a T account, you would have had balances brought down at that particular date. John would have had that. Levy would have had this. Okay, so it really doesn't matter which way you do it. I'm going to do it both ways. Obviously, we're going to start with this one, I guess, okay, because you're creating that as the structure. Okay, so we need to check, what do the partners get entitled to? Profit.
Yeah.
How much profit did the business make? Let's see. There. Current accounts, John and Levy. Opening balances. Okay, but what are we looking at here? We're looking at the adjustment of their capital accounts based on what? The changing partnership. That's the key. Okay, so if you were given those balances, they tell you that their current accounts had that. So there's their current accounts. You see that? Okay, so we need to close off the current accounts to the capital. So transfer the current account balances, opening balance. Okay, so what did they have as opening balances? John had an opening balance on his current account of 31,000. Okay, so 31,000, this is positive, so it's going to increase his equity. Okay, so 31 is going to go up, and Levy had 17. Okay, so that would have been capital, or current rather, transfer to capital, current account. Okay, so I'll copy paste current account for both. Right, they had opening balances, 31 for this partner, and 17 for that partner. Okay, so that's what they get in terms of the day-to-day running of the business. Okay, just to revise, capital represents what? The money they invested. Current account represents what? Well, the operations. Okay, what do they get from the business for being a partner? Okay, what else do you see in the question? Share of profit. What is that going to do to the entitlement?
Increase.
It's going to increase it, correct. So, this would have been the profit for the year transferred to current/capital. Okay, so I'm showing these line items separately.
Yeah.
What you could have done is, how many marks is out of? It's out of 4. Okay, so you probably do need to show more. Okay, so let's show more just in case. Do you agree I could have shown the closing balance, I could have shown the closing balance here, or I could have shown all of the line items. I'm showing all the line items, then I'll show the net amount just now. Okay, so what is the share of the profit? 15. What is 15 going to do? Increase their equity. They both get 15. Obviously, they share things 50-50. That would have been profit and loss. No, appropriation. Okay, so if you're doing T accounts, the profit comes from appropriation.
Can I just say profit for the year?
Transferred to the current/capital. No, rather say the whole thing because that is what you're doing. Okay, 15,000, 15,000, 15,000. Okay, and then there's drawings. Obviously, what does that do to the capital? Drawings transferred to current / capital. Okay, so the drawings is going to decrease it, so minus. Drawings for the one, 21,000. Drawings for the other, 37. Okay, so that's the drawings. If I'm looking at the tier count, I would have put drawings here. And I would have put drawings there for each of the partners. Okay, so 21,000 there. 37,000 there for levy. Okay, what's next? After that, you've got the closing balances. Okay, so the closing balances, do you agree would have been the net amount here?
Mm-hmm.
Okay, so that you don't have to show because this is one figure. I'm going to highlight this. Okay, do you agree? If I add up all of that, see, that gives me there 25,000, the sum. Okay, if I add up all of this, that gives me the 5,000. Okay, so all of those three amounts give you this like working total. Okay, so this you could have said asterisk closing balance / net effect. Okay, I'm just showing additional workings here. This you don't have to show, I'm just showing you for understanding. Okay, so that's what I've got as the adjustment to the capital that was from where? The current account. Okay, that's the closing balance of net effect from current account. Okay, great. So we've got the easy marks. Let's read the information.
So I don't have to do this, eh?
You can show it if you want to, but just say net effect from current account, but show it as an asterisk, just as a separate line. Okay, and then if you want to put a circle or a square around these ones. Okay, so don't highlight, just put a circle around those three.
Net effect.
Just put a circle around them. Net effect from current account. Yeah, 25,000 and then minus 5,000. So the one is in brackets. $5,000. Okay, addition information. What do you read there?
So what am I circle these for?
Circle these three.
Why?
Because those three make up the 25. Those three make up the minus 5. Okay, profit and losses shared equally. Have we shared the profit? Yes. Interest to be charged 5% points. Have we shown interest? No, we need to. Okay, so what is interest going to do to the current account?
What is interest going to do to their current account? Increase their current account.
Yes, no. This is interest on drawings. So if it's on capital, yeah, it will decrease. Okay, so let's put that in. Okay, so interest on drawings. Again, in brackets, this asterisk from current accounts. Okay, the thing is, I'm showing additional workings here purely because they're asking you for one thing, but this one thing is going to be affected by other things, if that makes sense. Okay, so the interest on drawings isn't going to be affecting the capital directly. It affects the current account, and therefore it affects the capital. Okay, but I'm showing it here as a separate line item in the actual capital T account. Okay, so interest on drawings will decrease their capital. Okay, so the drawings, there's the drawings, times it by 0, 0, how much? 5%. Okay, so there's the one amount, there's the other amount. Right, so what is that going to do to the capital? It's going to decrease the capital. Interest on drawings. Okay, so if I was doing a T account, I would show interest on drawings on those sides, and I would show that for John, and I would show this for Debbie.
Okay.
What's the next one? Point 3.
Where are we at? Interest, no.
Point
What
3.
is closing balance?
Point 3.
Interest to
Interest.
be allowed at 10% of the capital.
What is that going to do to the capital?
Increase.
Increase it by affecting the current account. Okay, so again, interest on capital, but obviously this is from the current account. Okay, so where's my capital? Here's my capital. That times 0, comma is a 10%. Yeah, so 1. Okay, gives you that figure. So the partners get an additional 20 and 7. So interest on capital would have gone on this side. You need to move this down. Interest on capital there. Okay, so interest on capital would have been shown there. This would have gone up by 20. This would have gone up by 7. Okay, what else? Next point.
Okay. 20,000. Yeah. Okay. Next. That's all. Okay, so now those things.
Damien introduced
capital of 80,000.
Okay, that doesn't affect the capital accounts of John and Levy. That's something separate.
Goodwill has valued at that.
Okay, that will.
Yeah.
Okay, who gets the goodwill? The partners, exactly. So that point we haven't looked at yet. We need to. Okay, so allocation of goodwill to the existing partners. Okay, so those partners get the benefits. Obviously, they're sharing everything equally, so they're going to get 30-30 here. 30 for that partner, 30 for that partner, everybody gets half. Okay, so half for John, half for Levy, and now we've allocated the goodwill. Right, each partner needs to share in the appropriation of goodwill. The splitting of goodwill. Okay, they said prepare the capital accounts to the partners to record that mission. Right, the last thing we need to add here is allocation of the revaluation. Was it a benefit? Let's go back and check. Yes, it was. Revaluation, let's say increases or increase. Okay, so this is from, I'm going to just put an asterisk here, from part A. Okay, that came from the first working we did. So all I'm going to do is show it. Each partner gets 133. Okay, there's the last bit. Right, then what must I do? Total up. Right, so closing balance would have been the opening balance plus the change plus the minus that plus that plus that plus that. Interest on capital, allocation of goodwill, yes, minus that, only 1. There we go. Okay, copy paste, and that's what we've got. Okay, so closing balances for the capital accounts for the end of the year is that. Okay. Then we've got theory. They like theory, hey? Looks like it in these ones compared to last year. Last year didn't test much theory. Here every assignment has theory, which is good in a way, but not a lot of theory is covered in the textbook. They give more of the accounting. So some of this you might have to just think about and answer. Okay, so for what, 4 marks? Yeah, well, 2 separate questions. Okay, so that was B. Okay, let's look at C. Okay, what does C1 ask for?
C says, state the advantages of interest on capital and interest on drawings to the partners.
Okay, so the first one is to the partners. So let's write it down. Interest on, here, you try to answer it actually, because you should know what it does. We've looked at it now.
So, interest on capital, an advantage to the partners on interest on capital, they get something back.
Yes. Interest on capital increases the partner's equity in the business, i.e. increases the current account. Bracket, credit. Okay, it's a credit on the actual current account.
Increases the partners?
Yeah, I'm just summarizing. You can write it down in a sentence if you want to. I'm just writing down the main bits. Okay, so interest on capital increases the equity. How does it do that? It affects the current account. The current account is credited because it increases. Okay, that's the advantage. Maybe we should just say advantage at the end. Okay, it's an advantage because the next one is not an advantage. Okay, no partner wants interest on drawings, but you can have it. Okay, so the next one, interest on drawings, is the complete opposite. Decreases. I'm taking the same definition, just changing the word increase to decrease. Decreases the partner's equity in the business. Decreases the current account. Debit, not credit. Debit and disadvantage. Okay, so it's literally the exact same thing, just the opposite. Okay, and that's the first 2. Now we've got something else, D.
Let me just catch it.
Okay, so we've explained it, we've looked at the example, we've actually transferred it to the accounts. You can even see it here. Interest on capital, good. It increases their capital, their current account. Okay, interest on drawings, bad. It decreases it. So, yeah, straightforward. The example question before it actually helps answer it. Got that? Almost, okay.
Okay.
Okay, next, D.
Did we do CI? What about double I?
Partnership. Oh, okay. I labeled this incorrectly. Okay, well then it would just be this. What does interest on capital do to the partnership? Interest on capital will increase the benefits, the total benefits for the partnership. No. Other way around. Sorry. Interest on drawings will do it. So this will decrease. Change the word increase to decrease. Okay, because now we're thinking about it from the partnership's point of view. Okay, with the partnership is going to have to pay the partners the interest on capital. That makes sense. Okay, so we'll decrease the total benefit of the partnership because the partnership must pay, or pay is inverted commas, must inverted commas pay the partners interest on capital. Okay, and then obviously we would just reverse it. So change the word capital to drawings. Okay, so interest on drawings will increase the total benefit for the partnership because the partners must pay the partnership. Okay, then it's the other way around. Okay, so interest on drawings, the partners pay it to the partnership. Interest on capital, the partnership pays it to the partners. It's just the opposite, okay?
I don't know where I am now. Okay, interest on capital will decrease the total benefits of the partnership because the partnership must pay the partnership.
The partners must pay the partners. Yeah. You were reading this one. That was the one that you were busy with, interest on capital.
Because the partner pay the partner interest on partnership must pay the partner.
Yeah, the partners interest on capital. Yeah.
Must pay the partners.
Yeah, just change the word partnership to partner. The partners.
Pay the partners.
Yeah, the partners.
Yeah.
The partners.
Interest on capital.
Yes. Okay, because that's what's happening. Okay, the partnership pays it to the partners. And then the other one is the opposite. Okay, and then the last one, that one. Okay, this is where you have interest on drawings, so now it's the opposite.
So interest on drawings will increase the total benefit for the partnership. Okay. Cool.
Last one, D.
Okay, explain how the terms of the partnership agreement will affect John and Levy.
Okay, so what were the existing terms? Just go back and check.
Okay, so first is John I, and then part 2 is Levy.
Yeah.
Profit and losses must be shared equally.
Okay, that's fine. What else? Anything else?
Interest to be charged 5%, interest to be allowed 10% on capital.
Yeah, they don't give you much else than that. Then how are they expecting you to answer? Maybe they want you to talk about the change.
John and Levy have been in partnership for some years.
Yeah, so if it's equally,
then a partnership agreement is steps and yeah.
If it's equally, then is it going to go up or down?
I don't know.
It's going to go down. Okay, because here they said, explain how the terms of the partnership agreement will affect. So who's coming into the partnership? Damien. So you're admitting a new partner. How is that going to affect them? Before they're sharing it equally, now it's not 50-50, it's a third, a third, a third. Okay, so maybe that's what they want you to discuss. There's nothing else here that talks about the terms, and we don't have the contract, so we can't look at it. Okay, but what we can say is that before admitting Damien, comma, John gets 50% of the partnership. After the change, comma, John will only get 33 or a third, 1 over 3, or let's just say get a third of the business. Okay, and then you would actually have to say the same thing for the other partner. I don't see how else you could answer that question, because they don't tell you anything else about the maybe you could talk about goodwill, perhaps, but then both partners get goodwill. Explain how the terms of the partnership agreement will affect John and will affect Levi. Well, the terms of the rules. So, yeah, I'm not quite sure how they want you to answer that because they don't give you the.
They share profits. I think we should say they share profits and losses equally.
Which is what they had before, but equally between two partners. Now it's equally between three, which is that, a third. What else could you say? Yeah, that's about it. I don't think you could say anything else unless they gave you more information, which they don't. I don't know. Do you want to add anything else? Can you think of anything else?
I would just say that they share profit and losses equally and their interest rates.
Okay, so then maybe talk about that then. Yeah, so maybe add the interest on capital and interest on drawings. Okay, you can maybe talk about that. You can mention it. Okay, but yeah, you would need the agreement to actually say how it would change. So, not a very good question there.
Okay, so let me just finish it with John.
Yeah, both parties get it. John and Levi.
Yeah,
both.
but it's John and Levi separately. That's why I'm doing it separately. So John pays 5% on drawings. And 10% on capital. Is that right, eh? If I say that?
Yeah, 10% is what he earns, 5% what he pays. Okay, he doesn't pay.
Yeah, he gets.
And gets 10% of capital. Well, and just say 10% of capital is earned. Just say that is earned. See, John pays 5% on drawings and 10% on capital is earned. Because he earns on his capital, he pays on his drawings.
Sorry, I just need to see this. Sorry, I just need to get the proof of payment for something.
Question 4 says, Z and Y, who, share profits and losses in the ratio 2:1, decide to dissolve their partnership. Okay, so dissolve means to end.
Yeah.
Okay, so they're ending the partnership, they're closing it. Their summarized statement of financial position as at 30 September 2017 was. Okay, is that important? Yes, very important. Remember, when you end a partnership, you need to revalue the assets. Okay, because you need to know how much does A get, how much does B get, and then they go their separate ways. Okay, that's what happens. Alright, additional information. Okay, they talk about land, The land and buildings were sold. Okay. Then they say Y took one vehicle. Okay, so that's looking at the change. Let's see what they're wanting you to do. A, prepare the partnership realization account. Okay, the realization account that we've done before is a T account. So draw up a big T account. Big T. Okay, let's see. Yeah, that's fine. Okay, this is out of 5. Okay, there's quite a bit of workings then. Okay, the heading for the account, realization account. Normal T account, realization account, debit side, credit side, and then we can post. Okay, so what do we do if we're going to be posting to the realization account? Well, what's the focus here? Dissolving a partnership. Okay, so if you're dissolving a partnership, what are the 3 accounts you need to have? Well, realization is 1. Then you need bank, because bank is the cash. The cash will be paid out to the partners. And the second will be the capital accounts. How much are they entitled to? Okay, so those are the 3 things that you need when a partnership is dissolved. Okay, so let me write that down. This is revision. You would have written this in the notes. Okay, realization, capital accounts, bank. That's it. Okay, so you're either paying out cash to partners and they go their separate ways, or you're giving them assets and then they go their separate ways. Doesn't matter, either or. Okay, so what happened?
Okay, so
we need to transfer. Okay, so what's the first thing that they give you in the question? Land and buildings. How do you close off land and buildings?
Credit.
You credit it. So if you credit land and buildings to close it off, you'll debit it here in the realization. Okay, so 30 September, land and buildings. All of this will be general journal again. Okay, it's closing transfers. Well, it's the dissolution of a partnership. And how much? 60,000. Right, there's the first one. What else are they going to be closing off? Well, what's the next account? What's the next account? Okay, same story. You close off that account by crediting it. So if you credit that account, you must debit this account. 10,000, yes. Okay, next, what else?
Okay.
What else?
Inventory.
Good. Same story. You close it off by crediting it, so you debit it here. How much? 14. Looks like it, yeah. Next.
Trade receivables.
Same story. How much? 16. Right, next.
Capital and liabilities, so capital accounts.
Okay, capital we can't look at yet because that would be their payout. Okay, so just highlight the word capital accounts, because you wouldn't look at that now, you would look at that later. You first need to see how much are they going to get from the actual partnership once it's been closed. Okay, right, so that we'll look at later. Okay, what else? Current accounts. No.
Yeah.
Oh, it is current. Okay, also current you would look at later. It's part of the capital.
Current liabilities.
Okay, there we go. Liabilities. How do we close off a liability? By debiting it. So if I debit the liability, I'm going to credit this account. Okay, so 30 of the 9. What is the first one?
Trade payables.
Okay, trade payables amount. Next, what else do you have? Bank. Okay, bank you also don't transfer to the realization because bank you would draw up separately. Okay, so what I want to do, just to show you how all of this works. Okay, this you don't need to write down. This is additional, but I want to show it so at least you can see it in terms of understanding. Okay, so do you agree? We've got other accounts here. We've got capital and we've got bank. Okay, so capital, who are these partners again? Z and Y. Okay, so Z, capital, Y, and then bank. Okay, so how much did Z and Y have? Capital account Z. Z had 40. Okay, so that's the balance here. 40,000. Okay, balance here. Y had how much? 25.
Must I also do this part?
No, you can just now if you need it. Okay, what else? Current. Okay, what does their current account look like? Z had a debit balance, so Z would have had current account here. How much?
10.
Okay, and then Y had 13, but his account was good. Okay, 13,000. Right, and then you've got bank here which has cash. How much cash? Oh, it's a current liability. Do you see that? Okay, so if it's a liability, bank has a credit balance. So this should actually be an overdraft. I'm going to leave it as bank. I'm just going to write the balance here. Okay, balance for bank, 6,000. Okay, so the only reason why I'm doing this is I want to show you how to actually transfer these accounts to those separate accounts. Okay, didn't ask for these T accounts. Okay, but if it was another question, then you would have had to have drawn it up. Okay, so that's why I'm doing it, just to practice and show you how to approach it. Okay, point number 1.
Okay, land and buildings were sold at 17.
So what do? You're selling land and buildings, so what happens to bank? Debit the bank, credit the realization. Okay, you're going to write in bank, asterisk, land and buildings, just to identify what it was for. How much did you sell it for? 70,000. Okay, see, notice, this is the credit. So where are you going to have the debit? In this account, bank. See, that's the only reason why I'm showing it. Realization, asterisk, land and buildings.
Okay. Y took one vehicle at an agreed value of 3,000 and the remaining vehicle was sold at 3,500.
Okay. So, what happened to one of the vehicles? Taken by who? Which one?
Y.
Okay, Y took. So this would decrease Y's capital. Do you agree?
Yeah.
Y takes a vehicle. This was a vehicle. Yes. It's motor vehicles. Okay, Y took the vehicle. This wouldn't have been motor vehicle though. It would have been asterisk motor vehicle. It would have been the capital account. Okay, so capital actually, and then motor vehicle in asterisks or brackets. Okay, how much was the value of the vehicle? Agreed value of 3,000. Okay, 3,000 is there, and then 3,000 must go into his capital. So here, that would have been realization, asterisk, motor vehicle. See, that's where the debit is. Does that make sense? See, credit this account, debit this account, 3,000.
Trade receivables realized at 15,000.
No, we haven't finished it.
And the other was sold for 3,500.
Okay, so if the other one was sold, bank is going to go up. Okay, so bank, because of the sale, motor vehicles. Okay, the motor vehicle was sold for how much? 3.5. Okay, so then you would have debited this account, and this would have been because of the vehicle that you sold. 3.5. Okay, next.
Trade receivables realized at 15.
Okay, so trade receivables meaning they paid you. So bank trade receivables. Okay, that increases your bank account, so you would have debited bank, credited the realization. You received the total of 15,000. Okay, so 15,000 would have been debited here in the bank. 15,000 would have been credited there in the realization. Why? You received money from outstanding debtors. Next.
Okay. Trade payables were paid after taking a discount of 1.5.
Okay, so after taking a discount of 1.5, so how much did they actually pay you? The difference.
Yeah.
Okay, so that would have been realization on this side. You would have credited the bank, trade payables, and the difference would have been, let's see, this side you would have put it here. This would have been bank, asterisk, trade payables, and then you have to show workings. I'm going to show the working just underneath it. Okay, how much was my trade payables? 26,000. Minus, what was the discount? 1.5. Close brackets. Right, so the difference there, 26,000, 0 minus 1.5 gives you that, 24,500. So that's what you debit. Okay, debit, bank, trade payables, because that's how much you paid. Okay, so I credit the bank. 24,500. Equals that figure, 24,500. Okay, next.
The inventory was sold at 12,000.
Okay, so inventory is sold, bank would have gone up, let's put that here. Bank would have been debited, this would have been credited. Why? Because of the inventory. Okay, how much was it sold for? 12,000. Okay, so 12,000 goes there, and then in the debit here, you would have had realization, inventory, if you were asked to do these other counts, and then you would have put 12,000 there as well.
And the expenses of dissolution was 1.7.
Okay, so expenses for dissolution, expenses, meaning you would have paid expenses. So realization, okay, and that would have been the dissolution expenses. Okay, dissolution expenses were how much?
12. No, 17.
1700.
Yeah.
Okay, so that is going to be recorded here. From the bank, asterisk, dissolution expenses. 1700. Okay, that's it. Now we need to wrap up. They said prepare the realization account. We've done that. Calculate the amount due to each partner when the bank account is closed on dissolution. Okay, that's the next bit. And then C, state 2 reasons why a partner. Okay, that's theory. Okay, we're almost done. Okay, so which side's bigger here?
I don't know.
We're going to have to add. So let's see there. That's 126. That's 129. The side's slightly bigger. Okay, so sum up this side, that's the bigger side. Okay, again, don't write this down, I'm just working out a difference just to see what the difference is, then we'll allocate it to partners. This minus all of these debits gives me that amount. Okay, was everything shared equally here? No, it wasn't. Okay, Z and Y who share profits and losses in the ratio 2:1. Okay, so 30th of the 9th, capital Z, what are these names? Zakai, capital Y, Yash. Okay, right, how much is it going to be? Well, I'm going to show this working in brackets. 3300 times, how much did Z get? 221, so 2/3. And then Yash gets 1/3. 33 times 1/3. Okay, so let's check. This times 2/3. Okay, this times 1/3. Okay, so that's what they get. Right, what does that do to the partnership? Well, the partner's equity increases it. So that's a debit. In their respective accounts, you're going to have credits. Okay, so in Z's accounts, you would have had realization. Okay, Z got that amount. Okay, and the same thing for the other partner, realization, they got that amount. Okay, so looking at what we've done, so have we answered A? Yes. What did A want?
The partnership realization.
There's it. Okay, what does B want?
Calculate the amount due to each partner when the bank account is closed on dissolution.
Okay, so that's the remaining. So actually you do need the other bit, but it was just a calculation, hey? Yeah, so they didn't say you have to draw up a T account. The T account has actually been the best way.
Marks.
Yeah, that's why it was a good thing I did that, because then you do need it. Okay, so question 4B, I'm going to just delete this and I'm going to show it here. Okay, there's question 4B. Question 4B. Alright, so they've said calculate the amount due to each partner when the bank account is closed on dissolution. So this account must be closed on dissolution. So we need to look at their capital balances and we need to see how much they're getting it paid out. Okay.
So that's all these tier accounts as well?
Yes. Okay, so let's balance it out. Okay, so if I balance Z's account, let's see. This side is bigger. This plus that gives me that. Okay, that side is bigger, so I want to balance. This minus that gives me the balance. Okay, so this is the balance carried down. Balance brought down. Okay, then we're going to close off these accounts because they're going to get paid off. Right, we would have to do the same thing for this one. Okay, so if I balance this account, this side is bigger. This balance will be that minus this. Gives you that balance. Okay. Right, so let me let you copy that down first. Just get the two capital accounts. Okay, so we've got capital for Z, capital for Y.
Sorry, there's a glare. Can I do that?
No problem. Okay, so yeah, just get the capital accounts first, and then we can discuss the last bit, which is literally just the bank. Okay, how much they actually get paid. Yeah, 40 for the balance, and then 2,200 for the realization. Okay, you've got the 10,000 ready, so that's good. And then just need to show the balance brought down, balance carried down. Okay, balance carried down on the left, 32200, 32,200. 32,200. 200. And that's the carried down and brought down balance. Yeah, so you'll have the same thing on the other side, and then just with the totals. Okay, so that account's done. We'll close that account off just now, we'll see. Let's just fill in the ones for Y. Okay, so Y had a balance of that.
Brought down, eh?
25,000.
Okay, then.
Realization. Well, current account, then realization. Current account 13,000, realization 1,100.
So current account and then?
Realization 1,100.
What? Oh, sorry?
1,100.
Okay, and then the other side.
This was the motor vehicle they took, 3,000. So realization, asterisk, motor vehicle, 3,000. We'll just say vehicle, 3,000. Okay, then you had balances. On the debit side, you had a balance carried down, 36,100. The credit side is bigger. Yeah, total 3910, okay. And then carried down, brought down 361. Okay, and then the last bit is just the balance and the working out. Okay, so you've got the two capital accounts. Right, so now looking at this, what happens at the end of the life of the partnership?
Must also draw the bank account there.
Yeah, just now. But we just need to finish off the capital account. So do you agree what is going to happen here? They're going to get paid out, right?
Yeah.
Okay, so how are we going to pay them off? Bank. See, this is the payoff, the payout. Okay, and that's what the question asks you to do. Calculate the amount that each partner would get in the dissolution. Actually, you don't need to draw up the bank. Okay, just say calculate the amount due to each partner when the bank account is closed. Okay, so when the bank account is closed, okay, you're going to close it off with that figure because that's what they want to. They said calculate the amount due to each partner. So I'm going to highlight that. Okay, this is due to the partner. Okay, the partner is going to get that. That's what that partner gets. That's what this partner gets. Okay, so you've actually answered the question already. If you want to drop the bank, you can, but you don't really need to because you've already got the balances. Right, because the question said calculate the amount due to each partner. Okay, when the bank is closed off in the dissolution. Okay, and then obviously I'm going to close off this account completely just to show you everything. So those two figures are going to go here. Those debits need credits. So these are the credits. I'm going to have capital here for the 1, capital for Z, and I'm going to have capital for Y. Z had this figure, Y had that figure. Right, and then the last step, if you had to draw up the bank to your account, would be to total up. Okay, and then if I had to sum up this side, I get that, and if I sum up this side, I get that, and that should happen. See, if you get it to balance, then it's perfect. There we go, that's good.
Yeah, then you have to state, so that question is done now, eh?
Yes, B. So this is B.
State 2 reasons why a partner may have an overdrawn current account.
Okay, so what are they saying? They're basically saying, what are the 2 reasons that an owner has a current account that's debited, basically? Alright, so a partner will have a debit balance on the current account if, okay, what? Come, you should know, think about it.
Just wait.
When would a current account for a partner be in an overdrawn position?
They drew too much.
There we go, there's one reason. The partner had previously drawn too much as drawings against the current account. Okay, so too much drawings would have a debit balance. What else?
Okay, maybe the interest on capital wasn't high.
Possibly, but that wouldn't always give rise to that. So a loss. Okay, sharing a big loss from a previous year. Okay, so if a big loss arises, a big loss will severely debit their current accounts. Okay, if you want to, you could also add an extra one in terms of interest on drawings. Okay, interest on drawings could also create a problem. Interest on drawings could also or will also, interest on drawings will also debit the account, which makes it overdrawn. Right, and that's another assignment done.